Welcome back. The job market remains the focus this morning. The Labor Department reporting that employers added 209,000 jobs in June. That was a surprise, weaker than expected. Unemployment rate came in at 3.6%, in line with expectations. In terms of where the job market has come, it was softer than expected, but still holding above that 200,000 level, still marking a sharp drop from May, when we saw May's number revised down to 306,000, but still a sharp drop when you consider it in perspective. Investors trying to read the tea leaves on what this means for what the Fed's next move will be, right, Seana? The expectation increasing for another rate hike, and that still remains the expectation heading into the Fed's next meeting.
Yeah, and I think that's clear really from the market's reaction, at least initially, to this report. The fact that we are seeing some slowdown in the jobs market did come in below expectations, added 209,000 jobs last month, still above 200,000. Unemployment rate, 3.6%. I don't think that this really changes anything for the Fed. We have taken a look at a couple of notes out this morning. Chris Rupke, one of those notes saying that the less than expected jobs data won't scuttle the Fed's plans for a rate hike on July 26th. You can bet on that. I also want to point out one thing that we haven't talked about much yet, and it goes along with that slowdown theme. But the number of people with part-time jobs, that increased by 452,000 to 4.2 million in June. Some of that increase being attributed to the fact that employers are cutting down hours worked here for their employees, but it does fall in line with that slowdown theme, some of the easing that we have seen in the jobs market, but still overall a way too hot report here, at least in terms of how the Fed is looking at this. Rachelle Akuffo has also been digging into this report, joining us now in the conversation here from D.C. And Rachelle, when you take a look at the market's reaction, we had the Dow and the S&P still in the red. The Nasdaq's actually holding on to gains, but I don't think it's changed the Fed's narrative or likely to change the Fed's narrative at all. What do you think?
I mean, I don't think so either. I mean, we know that the ADP numbers sort of set us up for the okie doke today in terms of expectations here. I mean, but you're still looking at unemployment below 4% for the longest streak on record. So look, the Fed is saying, we've been saying that we have more work to do. Clearly, the economy can take what we're doing. So even with this pause in mind and sort of letting the Fed's medicine work through the system, the Fed can still push ahead, which is why we're seeing these mixed markets. Obviously, when it comes to the Nasdaq, tech still sort of lifting all boats at the moment, whether or not they should be or not, depending on when you're looking at valuations. But also looking at annual pay rising at 6.4% in the US. So you have this pressure. Then you have a lot of employees saying, look, you're going to have to pay us to retain us. You have this historically low unemployment rate. So it's putting some of these companies in a very difficult position in terms of factoring in additional labor costs while they're trying to grow and they're trying to sort of pour into this bull market. So it's a bit of a precarious situation.
It is. It's a tightrope. I mean, we talked to one of our experts earlier from Kelly Services about the dance that employers are having to do, because employees are still saying, show me the money. Employers are saying how much, and then I just want to take this back to the Fed expectations really quickly as well. Looking at the CME Fed Watch tool, the expectations now basically over 90%, nearly 95% expecting a hike at this next meeting in July, despite these numbers, and especially when you consider that it's still above 200,000 in terms of how Wall Street reading it. It's still a mixed reaction in terms of markets, but as we've heard from expert after expert, the market is not the economy.
Yeah, the market is not the economy, not enough to put the Fed at ease here. In terms of where we did see the hiring, it was really concentrated in just a few sectors, led by gains in government, in healthcare, and in construction. Payroll is actually falling in retail, transportation, and warehousing. That's where we saw some of the drop here in the most recent months. But I think the conversation, it always comes back to wages, and that we know is so critical here for the Fed. It's a key component for the Fed. Wages increasing faster than expected, at a faster than expected pace in June, at 4.4% on a year-over-year basis, obviously lending to the narrative out there that the Fed is going to remain hawkish, remain aggressive in their fight to get what has been very, very sticky inflation here, Rachelle, under control.
All right.
It's true. But even when
Sorry, go ahead, Rachelle.
I'm just going to quickly say, when we pair that with some of the disagreements that we saw in the FOMC minutes about whether or not they should pause, it does mean that it's not a super certain road ahead. Clearly, there was some dissent in the ranks, so the final decision was unanimous. But when you have a data-dependent Fed who's sort of taking it ear by ear, still looking at those potentially 2 rate hikes, because as I said, the economy can clearly take it right now.
Oh, the next one's likely happening.